the earnings and, of course, the visibility as well going forward. We're still latching on to 24K marks. That really is the good sign as of now. Just want to, mark what the movers so far in trade are. And definitely it is some of those earnings reactions that you're seeing, or news-based moves rather. Sun Pharma is still standing in pole position, 1740 on the stock right now, holding on to its gains. Adani Power, Kotak Bank has made quite a sizable move, about 2.5% higher there. JSW Steel. And it's interesting to see that the beaten down names from last week, your Infosys, Wipro, M&M, for instance, they are the ones which are making a comeback. Metals as a sector and power, of course, are the most charged up. So look at right now, Hindalco, for instance, Tata Steel is holding out very well. Hindustan Zinc, we were just chatting with the management, a solid 4.7% move, no less, on that stock. And then, of course, there are other movers like a Torrent Power, which are holding up 6% as we speak right now. But IDFC First Bank, that reported an inline Q4 with very strong loan growth, but muted profitability because of one-offs. The asset quality improved, and the management expects deposit growth to normalize going forward as well. Sajid, in fact, caught up with V. Vaidyanathan, the MD and CEO of IDFC First Bank, to try and discuss the importance of performance and the way forward. Here's a slice of that chat.
First of all, every year we're used to posting a 20% growth or plus on deposits. This YOY was 17 and quarter was flat. Actually, there were two reasons, but very difficult to say what was what. The main reason is also that we cut deposit rates this quarter. We were paying 7% earlier, we brought it on to 6.5. In some buckets, we brought it on even more by 200 basis points. So customers who had probably kept the money with us only for rates, probably some of them would have taken out anyway for that reason. And we were prepared for that, flattening out for that reason when we announced the rate cut. And we knew this quarter will be flat and then will grow again. Also the fraud incident, very hard to choose what gave it. But frankly, the good news about the fraud incident is that we have like 7 to 8 million customers. Existing customers did not withdraw money. So that's something really good, we feel, and we want to thank everybody as well.
Your NIMs also came in good, 5.93% versus 5.76%. So quarter on quarter, good jump coming in for you. But how is the OPEX looking? Because it seems that you're guiding for a higher OPEX going into the next 2 quarters.
NIM, first of all, just to correct you, it is 593 by print, but actually read it like more like 5.8, just to be honest with everybody, because there is some, quarterly technicalities why NIMs tend to show a little higher. So read it like 5.8. On the OPEX fund, frankly, the bank on the whole has managed with only an OPEX of 12.5, and the balance sheet grew by maybe like 19%. So that operating joy is coming very well. Next year also, we think will be the guide of the same 13-14%. I think you're referring to the fact when I said for Q1, it could be a little more because of how Q1 plays out in terms of certain technicalities. But, it could be for Q1 because salary hike goes up and all that. But for the full year, we still maintain that just like last 2 years, in fact, last 5 quarters, our OPEX growth is only around 13%, but our income growth is 18-19%, or at least the book growth is 18-19%.
You're coming, going into the first quarter, April month. How has been the deposit growth for you? Do you see deposit growth going back to the 20% level on a yearly basis, if you look at it?
Yes. We are very sure about it. Like I said, we dropped the rates. Some temporary, slowdown happens, then things come back. So this year we will be back to good growth, and we say 20% is, we are confident about it. We're doing it for like 7 years, so this year should be no different. It's coming strong. And this Q1, month 1, as in the April information is also that our deposit growing very strong.
And how do you look at the credit cost for you? Is that is on a downward trajectory for you? Or is there a guidance that you have that how it's going to fare now?
Yeah, in the credit guidance, we had actually said, including the microfinance impact, we had said that our credit cost will be 2.1%. We are happy to say that we landed right there. because our Q4 credit cost was quite low. It was just about 1.65%. So blend for the full year, we landed in zone. Next year also, we believe that the credit cost of FY27 will be lesser than the last year, because other than microfinance, anyway, our bank had no problem anyway, if you see all the numbers. So microfinance has gone, impact has gone away. Rest of the book, credit cost is well under control. But more important to note, actually, we are able to get this kind of credit cost of, if we call it 1.8% of loans, or maybe 1.3% of assets, whichever way you look at it. We're able to get it despite yield being 13% plus. So it's very difficult for normally to get a bank which has that yield and this credit cost. It's or low credit cost. I think it's something about the bank.
Mr. Vedyanathan, give us a sense of the economy here. You cater to a lot of SMEs, the microfinance segments. The West Asia crisis, are you seeing some kind of pain going into that particular segment going into the year? Because so far the second order impact has not come through. But it will eventually be in form of higher costs, higher raw materials and others, and pressure on working capital for these companies. What is your assessment?
This is something that we should watch very carefully, very closely. The short answer is now, as we speak, Q4 results you've seen, it's very good. Q1 27, as far as our eyes can see, numbers are looking very good, so no impact right now. But in the longer run, we have to watch, because these are macroeconomic situations. We have done a very detailed study on this, on the various possibilities that can happen, etc., and discuss internally. We discuss it at the board also, and we are simulating, and we are, taking some measures on what sectors we want to slow down, etc., and what to grow. So these are things we constantly do. But as of now, there is no impact, and not even in the quarter that's going on, we don't see anything.
You think the impact of the entire crude shock is yet to come by, or is been absorbed so far, and companies are resilient in managing their entire P&L as we speak?
We should look at two parts. The corporate sector is usually very strong because of their, how deleveraged they are, and so on. The retail consumer sector is also usually quite good. That's 60% of a book. 60%. These are people who have taken home loans, car loans, consumers like you and me. It is the MSME sector, and particularly not even MSME. Within that, the micro sector, the segment, bottom of the lower end of pyramid, that's where our eyes should be very focused upon. And that's what we are also keeping a very close eye on.
Microfinance segment, sir, do you think that the worst is back and now you may see some growth? Because I'm asking this because you have taken a write back of 75 crores, which you had provided for earlier. Do you think that now it's stabilized and now it's expected to grow in a very disciplined manner going forward?
Yes, it is quite stable, and performance is good. Our gross NPA is down, net NPA is down, SMA is down. SMA is the pre-NPA bucket, okay, the 31 to 90 DPD bucket, that is also down. So we feel things are okay. Industry has also become more conscious, because last time it's an issue of the entire industry. So entire industry has put more guardrails in terms of microfinance. So I think, plus everything is insured, in microfinance now. Everything is insured through CGMFU, FMU. We have seen the back of it, we can confidently say.
You raise funds from marquee investors for the growth going forward over the next 2 to 3 years. Is that capital enough, or you may have to come back to the market to raise capital?
We will raise capital, because I told you it's an early stage bank. Till you finally see what happens, that you get growth. From growth, you get operating leverage. From operating leverage, your return on assets, return on equity grows. Once return on equity becomes 15, 16, then you're self-sustaining. You don't need capital. So we are walking down that path. We have already reached 0.77% return on assets in the quarter that went by, 0.75. If you just factor for this one time, the fraud incident. So 0.75. So our goal is to get to about 1.5 or so. And that path is there. When that path is reached, then capital requirement will not be there. But in the interim, we will raise capital.
How do you see return on assets to fare in FY27? Do you go inch closer to 1%?
Yes, why one? We believe that our model, when we lend at 13% plus and 2% credit cost, the risk adjusted 11%. Can you imagine where that return on assets will be when it settles? So it will grow more. But yeah, of course, in the interim sense, we want to go there. We don't exactly call out that which quarter of we will reach there, but you should see, a quarter on quarter improvement on that front, and we will go to one also, go past one also. You will watch that.
Finally, give us a sense of the loan growth that you're looking at. Are you looking at healthy loan growth, which is more than system loan growth at this point in time? And will you be able to outperform? Will your advances engine will be able to outperform the systemic growth rate?
See, thing is, the bank has built some very fantastic capabilities in being able to lend at a very predictable gross NPA, predictable net NPA, predictable credit cost. Like always say 2-1-2. 2% gross, 1% net, 2% credit cost. That model we have now perfected for 15 years now. And then the Indian economy is large, so we'll keep growing. To your question, like if you see next year, well, do we expect, as far as our eyes can see right now, we do think 1920s on the cards. Market is no problem, capability is no problem. But we have to watch out for the evolving global scenario. We'll play to the merits of the field and merit of the ball. If a market, global economic is weak or Indian economy is weak, etc., we'll think about how to deal with that at that point of time.
And how does that impact your, the cost of funds for you? Because you've been able to bring it down to 6%. Do you see that 6% is now seems to be a fair bottom now, given the fact that global headwinds are there? Many central banks are pausing rates at this point in time. Is raising funds from the private market or public markets going to increase the cost of funds for you going forward?
Looks like we'll be in the zone, in the sense we brought it down quite sharply, as you just mentioned. We brought down 180 basis points. In the last 1 year alone, we brought down by 50 basis points. So cost of funds around this rate, well, it will be in that zone, so to say. We don't intend to tinker much with the pricing now, as of now.